This loan estimate form has to be given within 3 business days. If you look on page 326, you can see an example of the loan estimate form. All right? Where it has all the projected costs. The second form they're going to use, they're on page 329, is this thing called the closing disclosure form. This takes the place of what we used to call the HUD form. Now we call it the CD, the closing disclosure. This actually is the score chart of that $5,000. In the example I'm using, remember, you bought a $100,000 house. It's going to cost you $5,000. You get that number from the loan estimate form. And that's made up of these 3 types of numbers. When you go to close, you're going to use this closing disclosure, and that is where all those numbers are going to be placed. So the estimate gives you the number, $5,000. The closing disclosure shows you where it's going to go. It's all the, think of it like the scorecard of that money. And if you look on page 330, you can see an example of a closing disclosure here. Loan amount, $162,000. The interest rate has your monthly payment right on the front. This form was created because it's supposed to help the buyers much easier, because it's right there on the very front. How much did you borrow? What's your interest rate? And how much your payment is? That's the most important thing. All right? So that's why they created this new form as opposed to the old HUD statement. This closing disclosure makes it much easier, supposedly, for the consumer to read. All right? So flip on over to 335. There's some other things. They got this thing called a toolkit. The CFPB provides this booklet you can get for your client if you want, that will help them figure out what their monthly payments can be and all kinds of stuff like that. No kickbacks. I've said it 3 times now. Probably a reason for that. Don't kick back anything. All right. So there's 2 new forms, the loan estimate and the closing disclosure. Those take the place of the old good faith estimate and the HUD. So now we call them the CD and the estimate form. All right? Are we good so far? Because now comes the fun part. Let's talk about preparing this closing statement. There are a couple of questions on the exam that deal with this, and I'm going to show you the easy shortcut way to get through this. All right? But before we actually write one, we got to talk about a couple of different things. The closing disclosure is nothing more than a series of balancing debits and credits. All right? A credit is something that becomes payable or they've already paid. Like a buyer will pay for the home inspection when they have it done. That's a credit. I already paid for it. All right? Earnest money. When a buyer puts down earnest money with the offer, that earnest money becomes a credit to the closing. I've already paid it. All right? A debit is something that is typically owed at the closing table. Like the real estate commission would be a seller's debit, because he's going to take it and pay the realtor at the settlement. That's where the term settlement comes from. We're going to settle up. That's when I get paid. I earned it when they pinned it. Now on the settlement date or the closing date, we're going to settle up. He owes me money, so it's going to be a debit to the seller, just like anything else. He's got to pay his loan off. Seller has to pay his loan off. That's a debit. All right? He got the purchase price of the house. Guess what that is? It's a credit to the seller, right? because he's receiving that money. The purchase price is funny. It's the only one that actually works out to be a debit and a credit for both parties. It's a debit to the buyer and a credit to the seller. Debit because the buyer owes it. He's going to pay for it at the closing table. It's a credit to the seller because he's going to walk away with that money. So they're on page 336. Let's go through these real quick. Now, let me reiterate on the exam. Do not come to me and go, well, if we'd have negotiated it this way, that answer would be, it's not what it says. And there are standard people that pay for standard items. So what I want you to do is we're going to go through these, and I want you guys to yell out at the top of your lungs, buyer or seller, debit and credit. So we get an idea. All right? So broker's commission. Seller's debit. Right? The seller's paying for it, and he owes it at the closing table, so that's a debit. The attorney fees. Trick question. Dance with whoever brought you. All right? So it's a debit for whoever brought their attorney with them. Now, with that being said, there is an attorney that looks at the deed to make sure the deed is not one of those jacked up things. So there's usually an attorney's fee that gets paid, and that's usually a seller. Recording expenses. Both of them have a recording expense, right? The satisfaction of the payoff for the seller gets recorded. The new loan and new mortgage gets recorded from the buyer, but the big one is the deed recording. Who has the most reason to have the deed recorded? The buyer does, because he wants to prove that he now owns the property. So when it comes to deed recording, that is a buyer's expense. Yeah, it's a debit for the buyer. They both have recording fees, but the most important one is the deed recording, because it shows the boop diamond transfer that happened. Transfer tax on states that use it typically is the seller. There's a lot of rules in here we're not going to get into, because if it's a federal loan, then it has to be a buyer on one of them, and yada, yada, yada. Just for general purposes, it's the seller. Title expenses, both of them. Remember, there's a lender's policy and an owner's policy. Typically, lenders paid for by the buyer, because they're the one bringing the lender. The seller pays the owner's policy. In our statement, it says exactly that. Owner's policy to be paid for by seller, lender's policy to be paid for by buyer. Check that box. Actually, they now split it into two, but don't worry about it. Okay, this one's always gets people for some reason. Loan fees. Buyer. He's the one getting the loan. How about reserve accounts? Buyer. He's the one starting the reserve accounts. The appraisal. Buyer. He's because it's required by the bank. Survey. Ta-da, who knows? I argue that one. But it's a debit. And then there could be other fees that get added in there, like an MIP if you're getting an FHA loan. Those are all usually explained to you on how they work. Now, in some situations, there are fees that have to get split. They get split between the buyer and the seller. These are fees that are typically based on a usage, like homeowners associations, taxes. If it's an investment property and there was rent, it gets split as to, hey, you owned it the first 10 days, I owned it the last 20. They're trying to get a hold of me, obviously. That's called a proration. You have to prorate something. Another one that's prorated, if you get into farmhouses, might be heating oil that's in the tank. Or propane. all of those things have to be split in some manner. So all proration is, it's a fancy word for how are we going to split this item? All right? Well, before we know how to split it, we need to know what type of bill is it? Who's paying it? There are two types of bills. The first type is what they call an accrued item. Accrued means it's paid after you use it, at the end. Who typically would pay that? The buyer would, right? Because he's the new owner. Think of a tank of water. It's half full. Well, if you get paid when it's empty, the buyer would be the new owner then, right? So the buyer's got to pay for that. There's also this bill called a prepaid bill. This is where you pay for it before you use it. Hence the word prepaid cell phones. You go and you put $20 down, then you use it. That's paid for by typically who? The seller, because the seller paid for it before they bought it, before they used it. So you've got two types of bills. Is it prepaid or is it accrued? All right, so let's go through an example here. I want to go through this so we can practice it. And I like to draw it kind of like an accounting thing. And I kind of like to draw with my marker if I can find where I put it. There it is. So let's assume we have a prepaid bill of $210. And it's $210. This is a monthly bill. We close on the 11th of the month. There's 30 days in this month. You've got the buyer on this side over here and the seller on this side. So my question to you is, here's the other thing. You guys are not going to be required on the exam to know what type of bill is prepaid or accrued. Doesn't matter. It will say using a prepaid bill of $210 or an accrued bill of $200, doesn't matter. They're not going to make you go, oh, is HOA prepaid? So they're going to say a prepaid bill. So in this particular example, we have a prepaid bill of $210. It has to be split. I don't know what the bill is. Doesn't matter. It could be gas. It could be utilities. Not a good example. Could be HOA. Could be rental. Doesn't matter. All you know is it's prepaid. So my question to you is, when it comes to debits and credits, who gets what and how much? You're saying the seller would get what? Because you peeked on my screen? Oh, because you did the math. So the question is, you said seller gets, so is that a credit or debit?
That is a credit.
So you're saying the seller gets a credit of $133. Is he correct? Is he? Say it, say it! So I'm back to school with, what was his name? Say it! Kennison talking to Dangerfield. Well, that guy's passionate. About what? I have no idea. It's got one of my favorite lines when he tells Sally Kellerman, well, call me when you have no class. He says, call me. She goes, well, I got class that day. Well, call me Tuesday. Well, I got class that day. How many days? Call me when I have no class. So we've got a seller, an answer of credit of $133. Is he correct? Well, other than the fact it says that on the screen, yes, he is correct. But what else has to be in there? Where does that seller get the credit from? There's only two people in this closing. Bingo, I told you I'd say it. Where did it come from? It comes from the buyer. So the buyer has a debit of $133. Is that correct? The answer is yes. Because here's the way you need to look at it. Who paid this bill? Seller. How much did he pay? No. He paid $210. But all of a sudden the closing popped up and it closed on the 11th, but he paid for 30 days. So he should get back money, right? He paid for 30 days of something, but he only used 11 of them. So he gets credit back for 19 days because the 11th is the seller's day. So there's 19 days left at $7 a day. Hopefully that comes out to $133 that he gets back because he's not going to use whatever this bill is. That credit he gets back comes from the buyer that now has to pay for those 19 days of whatever this is. So if I could wave my magic wand and make this the only bill at the closing table, it's my mythical $100,000 house I love to sell, the seller's going to walk away with how much money? $100,133. The 100 for the sale of the house and the money he got back from this bill. The buyer is going to pay how much? $100,133. Paying the 100 for the house and the credit to the seller that he gets back of whatever this bill is for 133 bucks. Are you good, Holly? Got it. Good, then let's do another one. Change the story. There's an accrued bill of $210. Now tell me who gets the credits and debits. Don't peek. I saw you, Maggie, peeking at the screen. I should have made these as fly-ins on the screen so you couldn't cheat. Who's paying the bill this time? Okay, first of all, what's accrued mean? You paid after you use it. So who's paying the bill? Let's try it one more time. Guess again. Who's paying the bill? The buyer, right? Because it's paid at the end of the month. Who owns the house on the 30th? Because it closed on the 11th, so when the bill comes on the 30th, who's paying it? The buyer. How much is he paying? He's paying all 210. Whatever bill that is doesn't care who owned it. Whatever the usage is, it's 210 bucks. So he owes $210. But that makes sense. He's used it for 19 days, but what does he need then? He needs the 11 days the seller used it. So at the closing table, the seller is going to give the buyer that $77. $7 times 11 days. So the seller has a debit going to the other side for that, whatever it is that he used for those 11 days. So think of it like this. What the buyer is going to do is take his money, collect your money, put them together and pay the bill. Here's another way of looking at it. The easy way to remember it. Whoever pays the bill gets the credit. Gets the credit. All right? So let me redraw it just so we can see here. This is an accrued bill. Seller, buyer. He gets a credit of $77. Here's another way that I always used to remember it. I love mnemonics. That's how I think my memory is so good. Whatever your name is there. See what I did? That's a joke. A, B, C. Accrued buyer credit. Now, hint, hint, if I tell you which party got the credit, you can actually tell me what type of bill it was. I'm just saying in case there was a question, perhaps on an exercise in knowledge later, where I ask you, if the buyer got a credit, what kind of bill is this? It's an accrued, ABC, accrued buyer credit. Okay? So now you can always tell what type of credit it is or bill simply by who gets the credit. Now, in this particular example, the accrued bill, these tend to stink for buyers. Because here's what happens. The credit comes in the form of not paying full price. So in this particular example, how much is the buyer paying for the house? $99,923. Everybody see what I'm getting at? His credit comes in the form of not having to pay the full $100,000. The problem with that is if your buyer's getting a loan for $100,000, he now just gets a loan for $99,923. When it comes time to make the payment, he literally has to reach in his pocket and pull that $77 out. Because it's not like he paid $100 and then was given a check for that money. His credit comes in the form of not paying for the house. And if you got a client that doesn't have a lot of cash but maybe has good credit where they could have got the loan but they don't have the $77, accrued bills tend to be a problem. All right? How does Indiana, just as a side note, work their taxes? Backwards? That's the right answer. Indiana is an accrued. We pay at the end of the taxes. All right? Not only is it accrued, it's a year in accrual. So we pay after we use it a year later. So the buyers always get a credit on the closing statement. Keep that in mind for your buyers when you're trying to figure out how much they got to pay to close. Well, you got that. Oh, but you're also going to get a credit, but it comes in the form of not paying for the house. It sounds good, but it's not getting actual money. All right? All right, let's stop for a second. I want to go to the next example.